Hi, it's December 1st, 2015, Tuesday. Tuesday before a non-farm payroll, which is coming out on Friday. But it's been an interesting day in the markets. We've had some interesting data in the US. The manufacturing ISM PMI number came out at 48.6. It was forecast to come out at 50.5, and it dropped from of 50.1 the previous month. So that's quite a big drop, and it's below 50, which means a contraction. So if you look at the headlines on Zero Hedge, for example, today, we've had some interesting headlines about the U.S. economy. One of them says Atlanta Federal Reserve slashes fourth quarter GDP forecast from 2.3 to 1.4 in under 1 week. So they've changed their mind very quickly there. The other thing that's happening today is Treasury bond yields are dropping quite sharply, and that's a sign that bond investors are less optimistic about the economy, and the Treasury market and the bond markets are much bigger than the equity markets. And there is a note saying that the bond market investors are a lot cleverer than stock market investors. The other headline here in Zero Hedge says CEO economic confidence implodes, drops to lowest in 3 years. And the another article that Zero Hedge has, and it's quite interesting. They look at the ISM manufacturing that came out really weak today, and they analyze it and say, time to hike rates, question mark. And they go on to say how the last time, the ISM manufacturing was below 50 was when the Fed started QE1 and QE3. And right now, it all points to Miss Yellen and the Fed hiking rates on the 16th of December. So just to have an idea about the U.S. yields, if you look at the 2-year Treasury yield today, it's dropped 4 basis points. So that's a fairly big drop for the 2-year note. The 5 years dropped 7. From around 165 to 158 yield. The 10 years dropped 7 basis points as well, from around 222 to 214. And the 30-year bond yield is dropped to 292 yield percent, and that's dropped 7%, and it's below 3%. And the other thing one needs to look at, for example, 1 year ago, the 3-month Treasury note yield was basically at 0, and now it's at 0.2. So it's gone up 20 basis points. But the 10-year yield, for example, that's gone down 8 basis points in a year. And the 30-year has gone up 3. So it just seems to be the shorter end of the curve that's pricing in, a raise in rates, but the longer end of the curve, which indicates, long-term economic conditions, is actually not moving that much at all. If anything, the 10-year yield has dropped in the last year. And another indicator I'd like to talk about, and it's an indicator, it's an index. Not many people talk about, you won't hear people talk about that on CNBC or the other news channels or Fox News, but it's something that the Federal Reserve economists look at, and it's the Journal of Commerce Index. I'll read here the definition from investorwords.com of the Journal of Commerce Index. An index that tracks the prices of a wide variety of raw materials used in industrial production. It is commonly used as an indicator of inflation. as wider economic changes are usually reflected in this index first. Each commodity is weighted relative to its established importance to economic activity and well-being. The index is continuously updated to reflect the changing importance, emergency, and obsolescence of certain commodities. It is maintained by the Journal of Commerce and the Economic Cycle Research Institute. So it's a very, very important index, in my opinion. And the Federal Reserve does follow this index, even though it looks like they're not really paying too much attention to it, unfortunately. I will be putting a chart of this index, attaching it below this video. But just to give you an idea, in 2008, the index topped just below 120. And during the meltdown of 08-09, this index crashed all the way down to just above 60. And since then, we've seen it rise to 150 last year. That was in 2014. And now, since last year, it's been going one way, and that's down, and it's right now just below 100. So it's dropped, like 50 points in about a year. So we've dropped from 150 to 99. And the last time we saw such a big drop was when the global economy was melting down in 08-09. So what this chart is showing is that we are right now in an severe economic contraction, even though we're being told that the U.S. economy is recovering really well and that they're going to have to raise rates. No matter what the Fed does on the 16th, and no matter what kind of data we get on Friday, I think no matter what they do, it's going to, it's not going to stop the economy, not only the global economy, but the U.S. economy from, slowing down severely. And in my opinion, Chair Yellen is running out of makeup. They've been able to put lipstick and on the pig, so to speak. Keeping the Dow Jones Industrial Average at near all-time highs. They've been doctoring the economic statistics, especially the unemployment or non-farm numbers. So I think Ms. Yellen, the chairwoman of the Federal Reserve, is running out of makeup. She better go do some shopping. Take care. Have a good evening. Bye.